Hi everybody, Patrick Donnelly here from Donnelly Financial Services. Today I'm going to discuss how to optimize your retirement savings by utilizing multiple types of IRAs. Now to start, I just want to get everybody on the same page in terms of terminology. The acronym IRA stands for Individual Retirement Account. It's typically used as an umbrella term under which different types of IRAs would fall under. So for example, 401ks, 403bs, Roth IRAs, and traditional IRAs all fall under the IRA umbrella. We typically use these types of accounts as our primary retirement savings vehicles because of their tax advantages. And I know some of you hear the word taxes and probably get a little intimidated, but please stick with me. I feel it's fairly simple to understand some of these mechanics within these accounts, and super important to understand if you're looking to optimize your retirement savings. Okay, so let's start with the traditional IRA. When working with the traditional IRA, there's two key advantages to understand. The first and most immediate being that all contributions made to the IRA are tax deductible in the year that they're made. So, as an example, if you were to make $100,000 this year, and of that $100,000, you choose to contribute $6,000, which is the 2021 annual limit for contributions. If you contribute that $6,000, in the eyes of the IRS, you have reduced your taxable income from $100,000 to $94,000. So not only will you not be taxed on that $6,000 of income, but you're only going to be taxed on $94,000. Potentially dropping you to a lower tax bracket, but ultimately saving you a couple $100 year in and year out. Second key advantage comes on the investment side. Once you've contributed money to that traditional IRA and have that money invested, you will be deferring all capital gains taxes that you recognize within the account. Meaning you can recognize gains and losses from buying and selling investments within the account and not have to pay taxes on those investment gains. So, first key advantage, you get a deduction in the year you make contributions to a traditional IRA. Second key advantage is that as you recognize gains and losses in the account, you do not have to pay taxes on those gains. Moving on to 401ks and 403bs, first thing to note about these plans is that they have the exact same tax advantages as a traditional IRA, meaning that your contributions are tax deductible in the year that they're made, and investments held within these plans will grow capital gains tax-free over time. 401ks and 403bs are known as employer-sponsored plans, meaning that they're just set up through your employer to make contributions directly from your paycheck into these retirement plans. Because they're employer-sponsored, they come with two additional key advantages. First one being that instead of that $6,000 annual maximum contribution that applies to a traditional IRA, that's extended to $19,500 in employer-sponsored plans. So on an annual basis, you can contribute up to $19,500 to the plan, getting all those same tax advantages and reducing your taxable income on an annual basis. Second key advantage is that oftentimes in employer-sponsored plans, there's what's called an employer match, where essentially an employer will match your contributions up to a certain percentage. Say your employer matches your contributions up to 3%. That means if you elect to contribute at least 3% of your salary, your employer will essentially match that contribution, doubling your retirement contribution on an annual basis. Two huge advantages for the 401k and 403b. The only difference between these 401k and 403b plans is that a 401k is set up for for-profit companies. A 403b is set up for nonprofit organizations such as hospitals and schools. Finally, we arrive at the Roth IRA. The Roth IRA essentially acts as the inverse to the traditional IRA, 401k, and 403b. Because the contributions you make to a Roth IRA are not tax deductible. Instead, you're using post-tax dollars from your checkings or savings account that has already been taxed and contributing to a Roth IRA, essentially deferring that tax advantage or that tax deduction. In doing so, the IRS allows you to grow this money tax-free for the rest of your life. essentially meaning in retirement, when you go to draw on this account, it will not be taxed. No capital gains, no income taxes. Whereas with a traditional IRA, a 401k, or 403b, those withdrawals will be taxed as income during retirement. So it's an incredibly enticing retirement savings vehicle and probably one of the very, very few gifts that the IRS has actually ever given to the American people. So in beginning to wrap this up and actually apply it to your own retirement savings, my suggestion is to think about it and prioritize it as a bucket filling strategy. The first bucket to prioritize and fill would be that employer 401k or 403b employer match. At the very least, you should be getting the match that your employer will provide for you. It's free money. The second bucket to prioritize is make sure that you're filling that Roth IRA bucket. It's an incredibly enticing retirement strategy, and there's no reason not to take advantage of it at this point. Third priority, or third bucket, would be to revert back to contributing to that 401k or 403b, taking advantage of that higher $19,500 annual contribution limit. On top of that, it's really up to you. You can choose to invest in an investment account. You can work in a traditional IRA if you still have some contribution limit left over. But it's really up to you from that point forward on how you'd like to allocate your retirement savings. So with all that being said, I hope you found this useful, and please, by all means, if you ever have any questions on any of this, please reach out via my website or other contact information.